Assalamu alaikum everyone, this is Abdulaziz. Today we will start financial accounting lessons, and also I chose the English language because I think that that's not a problem for those learning ACCA, and also I have to reach more people, and English will be a bridge for me. Okay, right now, what is accounting? First of all, accounting means recording and summarizing. Okay, first of all, what is recording, right? Recording means actually it is recording. How? We write the transactions on our notes, on our journals. That is called recording. After that, the information that was recorded is summarized. How it is summarized? It is summarized by preparing financial statements. Why it is summarized? Because when we record the information, it is not useful. In order to make it more useful and more meaningful, we need to prepare financial statements. There are 5 types of financial statements: statement of cash flows, statements of change in equity, statement of financial position, statement of profit or loss, and notes. Okay. Actually, it is the information about financial accounting, and why I'm saying about that is there are 2 types of accounting. What the information that we have talked was about financial accounting. This one, right? 1 minute. Yeah, this one. Financial accounts present the information in a way useful for public by preparing financial statements. That means financial accounting is for public. The public means investors, workers, tax organizations, or the government, and all of the people that are affected by the operations of the business. And what is management accounting? Management accounts present information in any way that may be useful to the management, right? In this case, we may see that accounting also helps management to prepare financial statements. For example, what is happening in the business. And there is a big difference between financial accounting and management accounting, and one of them is the time, because financial statements are usually prepared annually compared to management accounting, which is prepared time to time, or maybe it may be called on demand when it is needed. Okay, now let's continue. Let's talk about types of business entities. There are 3 types of business entities: sole trader, partnerships, and limited liability company. Before talking about types of business entities, I also make you remember that we are only talking about financial accounting. FA, or we may call it F3, is only about financial accounting, right? Management accounting, we won't talk about that. Sorry, I have a cough. And first of all, sole trader. Sole trader means like if you have opened your business and you are the owner, you are a sole trader. This is the simplest form of business entity where business is owned and operated one individual. Yeah, we have talked about that. Although it may employ any number of people. For example, let's imagine your uncle opened his business and you were employed, and he is only responsible for his business, and it is called sole trader, and you are his worker, right? With this form of entity, there is no legal distinction between the owner and business. That means in form of accounting, sole traders and their business are the same, or they are one entity, right? Single entity. However, from legal perspective, they can be looked, or they can be considered other entities, and we also talk about that in the next lesson. To this end, the owner receives all of the profits of the business, but has unlimited liability for all losses and debts of the business. And actually in this example means your uncle is responsible for the debts of the business. If the business cannot cover its debts or losses, your uncle will pay out by himself. Sorry. Let's talk about partnerships. It's also similar to sole trader, right? And in this example, your uncle and his friend opened their business, and it is called partnerships. And the owners of the partnerships collectively receive all the profits and have unlimited liability for the losses. That means they are separately liable for the debts of the business. They may go in jail because of the debts of business separately. Or if your uncle does not have enough assets to cover the loss of the business, your uncle's friend is fully responsible in this case. The key distinction is that there are at least two owners. Yes, you see? There are at least two owners. And in the single entity, there was one individual who was responsible for the operations, who was responsible for the management, right? The joint ventures partners are jointly severally liable for the losses of the business that makes. We have talked about that. Unlike sole traders, partnerships, a limited liability company is established as separate legal entity to their owners. This is achieved through the legal process of incorporation. Okay, imagine big companies, for example, Apple, Amazon, all of them are limited liability companies. That means owner is not responsible for any losses. I mean investors, right? They are only responsible for the money that they invested. Business is another legal entity, and it can take debts under its name. That means if the business cannot cover its debts, no one is responsible in this case. No any directors, no any investors. Okay. There is also conceptual framework. What is conceptual framework? Conceptual framework is a data which financial statements are prepared depending on it. It is a core data, right? And also international financial standards are also prepared according to this data. Conceptual framework. The conceptual group presents the main ideas, concepts, and principles upon which all international reporting standards and therefore financial statements are based. We have talked about that. And also there are qualitative characteristics of conceptual framework. That means there are some characteristics and also some mandatory, not mandatory. We may also talk mandatory or not, also not mandatory, right? Characteristics. Relevance and faithful representation are fundamental characteristics. They should be mandatory. Qualitative characteristics. Timeliness, understandability, verifiability, comparability. What is the difference between them? Right? What is the difference between fundamental characteristics and qualitative characteristics? The main difference is that they are mandatory, and it will be good if the financial statements have these characteristics, right? Now we will go through the definition of these characteristics of conceptual framework. First of all, relevance. What is relevant? The information is relevant if it affects the decision of the users. Let's imagine about the information that is being given. It is relevant if it affects you or if it is about you, right? For example, we mostly don't care about the information about other people because it is about their life. If it is about our life, we care, and in this case the information will be relevant. And also another one, faithful representation. The information needs to be free from error, bias, and it should be neutral to be faithfully represented. which means you cannot make any errors in the financial statements, and also there is not any bias, which means it's not it shouldn't be favorable for any users of this information, and also it should be neutral, right? We have talked about that. Sorry, I have cough and it's making us some troubles. Timeliness. Having information available to influence the decision of users. The older the information, the less useful it becomes. We can take the news as an example in this case. Timeliness works there. From the real life, I'm counting examples. For example, if the news is about if the events in the news happened within the 1 week, the timeliness is very high. For example, we don't care about the news that the events in the news that happened 1 month or 3 months or 1 year ago, because they are not relevant, they are not for us. In this case, timeliness is not working. Understandability. The information should be understandable. There should be 4 people. I made grammatical mistake. With sufficient knowledge. This means any professionalism is not required from users. They are not required to have a kind of bachelor degree in accounting. Information is understandable when the users have sufficient knowledge, right? Why I added this part? Because in most questions they want to trap the students by saying the users are required to have a professional language. To professional knowledge to read the financial statements. No, they are not required. And also there may be some questions like that. To make the information more understandable, it is allowed to make mistakes or to omit some information, and it is prohibited, because we have told that there is faithful representation. The information should be free from error, right? Verifiability means verifying, right? For example, it can be direct or indirect. Direct verifiability can be through direct observation. For example, counting cash for verifying cash balance, or indirect can be checking model, formula, or other techniques. Let's imagine you are working in a big company and you cannot count any products of the inventory one by one. In this case, you will use any kind of the model or formula and you will check it. If you are checking model or formula, it is indirect verifiability, and it can be direct. Let's imagine like you have money on your pocket and you are counting how much money do you have, and it is called direct verifiability. Okay. Comparability. The financial statements should be eligible for comparison over time by users. It should be the case there must be consistency and disclosures. This means there should be disclosing any events, right, in the notes, and also there should be consistency in the accounting models or policies are being used by the preparers of financial statements. And that is the end of our first lesson.